Hello to all. This is Chris from Solstice ATR, Axel. You can find us on Twitter, Instagram. You can DM us on Discord. This video is offered for everyone on weekly basis for free. You can subscribe to the YouTube channel. Doesn't cost you anything to watch the video. Give us your commentary. This is for educational use only. We use adaptive algorithm for side market, up market, as well as down market. Remember, we're not a broker dealer. Our past performance doesn't give us any indication of future results. And this data might not be copied unless it is requested from our website with an email or getting in contact with us right at that phone number right below. Let's go to the first slide. This first slide, I said, hey, will this market stick a fork in the bull market? We have to pay attention to the overall market and the trends. In this slide, I had put a couple of moving averages, and I colored the 5 and 18 simple moving average for one reason on the weekly to show you when the trend changes from weakness to strength. And the 18 simple moving average is the middle band for the Bollinger. I do not use a 20 SMA, which is this 18 is in green and red. That's an 18 simple moving average. The 5 is in cyan and burgundy. The 50 simple moving average is in 50. This is just a better 89 EMA. 116 simple moving average, a 200 and 250. Most institutions will use a 200, 250, and 100, and a 50 SMA and a 20. So try to adjust your trading according to what the market offers you. And I put here, is there going to be a fork stuck in the bull market? And I said, to be determined. Read these information. If you like more information, let us know, because I want you to trade what the charts offer you. You can trade the bull side, the bear side, or the side market without having a biased opinion. Okay? And this is once again where you can check us out. Let's go to the first slide up here. I'll put the SPX, the Fortune 500, as well as the Nasdaq. And here I switched the simple moving average from the 5 and 18 on the weekly to show you when the 18 and the 50 cross on the long term to give you the direction of the moves, whether to be biased to the bull side or biased to the bear side. There's most people are biased. We are not biased. We trade what the chart offers you. When there is a crossing on the 18 and the 50, that's a death cross. When there's the 18 simple moving average crosses the 50 and it is above, that's a bullish cross. So we trade what we see. And the reason why I moved it to 50 to show you on the daily how it acts individually on the S&P 500, on the Nasdaq, and a couple of other equities for today. I want to keep this video very short, and I will show you how to use the measured move, whether we use the weekly, the daily, or the hourly charts. They all act the same. There are ranges in between the bigger levels. Let's take a look at first. If I do a measured move, we're going to calculate it in units of 20 and 25%. If I take the March 23rd, 2023 till the December high on, the 11/22 in 2022, you can see where the 50% combination of these instruments, where we had the consolidation in 2020 area when we broke out and we came back, retested it here, and eventually we rallied up. We got two engulfing candles on the combination of the four. So this is how you will know where your ranges are for the past 3 years, the range in that territory. So that 50% is very important. So we're going to remove it. We can see in the prior year, this was our high for the year, okay, and the low for the year. So I'm using the measured move in relationship to the overall market. We can use a Fibonacci, but it's easier for everyone to calculate the numbers on a measured move. You know, units of 10%, 20%, 30%. You can see I've used a 50, a 25. You can make it 20 here and you can make that 80. But since the Fibonacci's are units of 23, 38, 50, 61, 78, and so on, and the extensions to the bottom the same way, and the extensions to the top the same way, at least you know we had reached the 78%. We looked into the 80 and we eventually fell down. If I get on the chart, I'm going to use this box. Think of it as, a drawing tool. I'm going to look at this area and this area here. You can see it, correct? So if I measure this correctly, okay, let's just do this correctly. Okay, there we go. And I activate it because I want to show you how I activate it. Move this up to the 100%. When we went up in that territory, you can see we retested the 80% up the top. Couldn't handle it, or the 78%. We fell back in and we lost the 18 simple moving average. The Bollinger Band, which is the midpoint, the 18 SMA on the combination of those two, giving you that band where the midpoint is. Usually when coming to that midpoint on the daily, the hourly, the 4 hour, usually it acts as support or resistance for breakup or breakdown through that band. So this is why I wanted to show it on the weekly chart using the S&P and the Nasdaq, the combination of those two instruments together instead of having one separate chart for each one. This is giving you an overall view of the tech and the S&P 500 and the overall market. Let's go to the daily. And I will get rid of that Fibonacci, okay? We know, or that measured move. We know where the level is that 75% is. If I take the high for the year and the low of March, remember, this is the January low. This was the March after the Silicon Valley dump. We rallied, consolidated for a month or so, and we broke up. Now we are coming back in. If you notice, the 18 SMA has crossed the 5, became bearish. If in the 50 SMA, we tested it yesterday on Friday on the close, couldn't hold it, and fell back in the range. We have to have an open mind. If this is territory, it's going to give us a reversal back up, or we're going to get continuation down to this area of consolidation. And you can see here between this candle and this candle, if I zoom in, I just want people to pay attention to these areas. This is what we call gaps in the profile. These are considered, edit the property. If I zoom it in, I'm going to color it to a cyan, and I'm going to extend a couple of little, candles out so everybody knows where the gap is. Those gaps are usually revisited. If you notice, there's a gap here, there's a gap here, there's a gap here which is being tested, there's a gap here. And up on the top here, you can see that between this candle and this candle, there's a gap. If I edit the property, rectangle 3, and I make it cyan again and I extend it to the right, you can see where, oops, I didn't change the color, did we? Edit the property, rectangle 3. We made it blue, but I'm going to get rid of that 80 so you know where it was. Remove the drawing so we can see it. So we know where those levels, virgin gaps are. Usually they are retested. They don't have to happen in the same day, but they allow you to know where those gaps are. Third thing I want to talk about is switching the 18 and the 50 when they cross, it becomes bearish. You can see how far we are away from the daily when we ran up. We stayed all this time in an uptrend on the 50. Now we retesting it and we close below it. Do we continue to the lower area, or do we continue to the upside? If I switch this to the 18, I'm going to edit this and I'm going to show you how I do this. This is an 18 and 50 simple moving average. If I put this back in here to a 5 and I put this, this one to an 18, it's going to switch the cloud for me to the up top. If I want to switch it between the 50 and the 116, okay, going to add this to the 50 and the 116 SMA here. I just want to give you visual how far we are away from these levels. So if I zoom back down, we know the trend, the 50 SMA for long-term swings is the line in the sand to hold you up. I have an 89 EMA. The reason behind it, it's between the 50 and the 116 simple moving average, and this is why I'm doing a better test on it to keep me in line if we come back and retest that outer band of the Bollinger Band, which is a little bit extended than the regular band that they have. Usually those bands I don't want to pick on anybody, John Bollinger or any technical analysis. I'm a technician. I trade what the market offers us. You need to learn how to use technicals for your advantage without being biased. So trade what the charts offer you, not what you think. And this will help you know how to set up the levels. If you can see, I have the resistance here, the support here, my 50% here, and my 38. If I get a regular Fibonacci for the chart, and I'm going to use this Fib, I'm going to grab this high from here to this low here. So I want to show you how the machine did it automatically. These are the regular fibs that we use technicians, or usually these will act as support or resistance. And even if I draw this backwards, I'm going to remove it. And I draw from bottom to top because we were going higher. This is the correct formation. Coming back even to the 38% or the 23, usually they act as support and resistance, 50 and 61 for big bounces. So we trade what we see, not what we think. Let's do one on the SPY by itself, or an equity. SPY, which is the ETF for the S&P 500. If I'm going to look at it on an annual basis or a weekly basis, we know the high was here, the low is here. Our January low is here to this high here. So where is my support? In the real world, my support should be coming back to the 430 area. 440 may hold, but if it doesn't, you're going to look for the 18 SMA around 430 and 428. If not, the bigger band, which is around this area on the weekly, would be the 418. So what we want to do is go to the daily chart now, okay? And I wanted to show this area more as a technician than an individual trader. So if I take a look at the high and low for the year from the March low and the January low to this high here, this is the annual for this year. I know where my 23% is and my 38%. But the most important thing, does the 20% and the 50 SMA hold? If it does, it's great. If not, we look for the 430, 428, and eventually the 116 SMA before the bounce. And you can see here on the SPY, there's a professional gap here after this big consolidation range, and we broke up. Sometimes those areas, you can see them in the gaps, are visited. So we trade what the charts offer us, not what we think. And there's another gap here between here and here. You see, we look down, we got a gap up between this candle, and we rallied up, never revisited. So we have this area here. We have this area. It does not have to be visited, but the most important thing, you trade what you see on the charts, whether you trade Bitcoin, Ethereum, Apple, Amazon, Google, Netflix, Costco, Walmart, Lockheed Martin, American Express, Blackstone, whatever, Microsoft, it doesn't matter. You have to learn to trade the chart that's in front of you and the instrument you love to trade, but do not fall in love with it. You're in as a trader to trade to make a profit, not a loss. Let's do, for example, Apple, okay? I'm not going to do Tesla. I want to do Apple. After the earning report of this year, you can see I put this oval here and we retested a point. Whoops, where's my mouse? I lost it. Okay. You can see where I put this oval here. There's a small gap here. Did we retest 100% of this gap? No, we tested a portion of it until gap is fully visited. That's the first one. There's another one down here. You can see it between this candle and this candle. That's a big gap. Has never been touched. And so on and so forth. There's another one between here and here. So most important, you trade those levels, and there's one up the top. And I had told everybody, if we lose the 182.94, watch out from Apple. I had called the 194 in the group, and I put it on Twitter, and I told everybody, pay attention to 194.50. If this is lost, we're going to have a problem in Apple. That was if I drew an auto channel going up There's linear regression channels and so on. I want to keep this video short and brief. If I draw a channel from here to here, or to this candle here, you can see where the breakdown was. This is considered a breakdown coming down. You can wait for it to break down. Or even if I took this pivot point to this candle here, there's your breakdown. If I zoom in here, that's your fan or auto channel Fibonacci between this candle and this candle. When it fell through, there's no support. That was your confirmation after the 18 and 5 crossover, and the earning report was bad, dragged it all the way down. Does Apple find support here on the daily or the 116? Possibly. This is the breakdown of the upper channel on the weekly. You can see it here. If I zoom it on a weekly chart, this is the last one I will do for today's video. We were in that regression channel. There's a midpoint here. Eventually we consolidated. We pivoted off the 158, 157.50 and rocketed out. So coming back to this area is not it is a healthy way of getting a recovery, coming back down, picking up an area where there was consolidation and a breakout. This area is consolidation and a breakout. If Apple tests it and bounce off of it, that's a great area to consider. And you can see it on the weekly where the 18 is lost and we are far away from the 50. But between the 50 and the 18, there's a 32. So we trade Fibonacci's, we trade channels, we trade trend. So don't be biased. I hope this video was helpful. Once again, you can check us out at Solstice ATR. Get in contact with us. Give us your commentary. Happy Sunday, and I'll see you around.